Good morning. You're watching The Market right here in 18 Hour with me, Aisha Faridi, Anisha Jain, Avam Dabash in the studios. And this truncated week seems like we're back at Monday, but not quite. You've got a lot of important events lined up. A lot of banking updates have come in for the fourth quarter. And of course, tomorrow is the all-important RBI policy as well. The global markets as well have been heated up. A lot of news flow coming in with Trump's arrest. But that we will talk about in just a bit. Let's tell you how the markets have panned out so far. The Nifty has actually managed to gain about 400 points in just the last 3 trading sessions alone. So that's not looking bad. In fact, a whole host of experts now talking about the India equity markets and as to how they're finding value right now at these current levels after the recent correction that has played out. By the way, on Monday, it was a smidge of an FII buy figure, but a buy figure after a very, very long time as well. Timothy Moore from Goldman Sachs is saying that he expects the Nifty to reach 20,000 in a span of 12 months, saying it's time to accumulate for equities, buy quality at reasonable prices. He says the valuations are now back to reasonable levels and it continues to be a buy on dips market when he talks about India. He's also saying that the relative premium to the region has now halved from the record peaks. The returns are driven by 17 to 15% earnings growth that he foresees for the next fiscal. Also is saying that returns are going to be backloaded. So be patient, saying overweight on banks, industrials, cement. So all that is looking good. In fact, if you look at how the SGX Nifty as well is adjusted for yesterday's trading break, it is indicating a positive start for us. So don't go by what that muted start is indicating. It is an uptick that the SGX Nifty is indicating adjusted for yesterday's price action. So good going, but I think, Anisha, what's going to be in the news flow today is going to be all those Q4 updates, be it from M&M Finance or Bajaj Finance and, of course, HDFC Bank.
HDFC Bank clearly takes the cake. What an impressive figure when it comes to growth. And look at the, scale and size of that mammoth as well. We have seen very impressive deposit growth of around 60,000 odd crores, which is up almost 4% on a quarter-on-quarter basis. Even if you look at the, advances as well, they continue at a rapid pace. So HDFC Bank definitely deserves a thumbs up. And for others as well, the likes of IndusInd Bank, Federal Bank, the deposit growth has been decent and the advances rate actually continues, because for IndusInd Bank, for instance, 6.5% sequential growth in terms of advances, 21% on a year-on-year basis, and 20% for Federal Bank as well. Deposits to the tune of around 14 to 17%, so something that we are watching out for. But separately, even if you look at the NBFC space, Bajaj Finance and Mahindra Financial have done a very good job. For Mahindra and Mahindra, the disbursements continue at a rapid pace. 5,600 odd crores is what they have done in the month of March alone, and the Q4 disbursements now are close to 13,750 crore, and the bank, or rather the NBFC, also says that no additional provisions will be required on account of the ECL provisioning norms coming in. As far as HDFC is concerned, again, very good number coming in, but for Bajaj Finance, the core AUM is up 29% on a year-on-year basis to 2,50,000 crores almost, and the AUM as well up around 16,500 crores in the quarter itself. So a lot going for the banking space, and I'm guessing a part of the heavy lifting today will definitely come from banks today, Avan.
Absolutely. It's all eyes on what the RBI policy as well is going to deliver. And do remember, in light of the fact that we have, the committee, the MPC committee, closely looking at, retail inflation, the recent action as well that we've been seeing from central banks across the globe, the likes of the US Fed, the ECB, Bank of England, etc. All of that is going to be taken into cognizance. But those are the ET Now expectations, the poll expectations flashing on your screen, and it seems pretty much unanimous. That's what the street is expecting, that this time around 100% are saying that there will be a rate hike. So a 25 basis points rate hike is what the street expectation is, to 6.75%, and the stance, we understand, is likely to change from withdrawal of accommodation to a neutral stance this time around. Of course, there will also be a lot of focus on the kind of commentary down the line on liquidity, growth, food inflation, as well as core inflation. And you've already seen the RBI that has increased the repo rate by a total of 250 basis points since the month of May in a bid to contain the rising inflation. And that has continued to remain outside of the RBI's comfort zone of 6% for the most part. So you do have the MPC meet that has begun. That's from the 3rd, 5th and 6th of April, and that's also going to take into account a lot of the global factors as they come out with their first bi-monthly policy. This is for the fiscal 23-24. So all expectations are this time around that it will be a 25 basis points rate hike, Aisha.
Oh yeah, absolutely. I think the commentary is going to be more pertinent at 25 bips as well in the price. But what's also going to be in focus today is going to be Reliance, ONGC, and of course the entire OMC pack as well. Just yesterday, while the markets were on a trading holiday, but seems like the government was pretty active. The windfall taxes have been cut. It's going to be zero now on crude production. Windfall gain tax and domestic crude production has now been shelved. The government has actually withdrawn it. So if you were to just take a look at how the adjustment is going to pan out, the windfall tax and petrol out of windfall gain tax ambit. In fact, the tax on ATF exports as well is also now out of the windfall gain tax ambit. So you may see some reaction coming in on Reliance because the analysts have been working with, working their EPS estimates as well. And this is definitely going to be adding as a fillip to Reliance's EPS and the GRMs. The new rates, remember, they come into effect from today. So it would be interesting to see the reaction come in on a Reliance, ONGC, the oil marketing companies, and of course the aviation sector as well. So that's going to be interesting to look out for. But World Bank, Anisha, they're, while they are saying that overall the growth is going to slow down across the globe, but India is going to be the shining one.
Oh, well, yes. World Bank forecast did suggest that India is going to be that lone star which is going to do better. They have imagined a growth of around, 6.3%. As far as India is concerned, though they see labor market is something that needs to be a lot more inclusive, there is a bit of a downgrade coming in when it comes to the FY24 by around 0.7%. But looking at what's happening across the globe, this number is still very strong. In fact, they're also talking about the current account deficit, which is expected to be around 5.2%. There might be a bit of constraint when it comes to consumption. So that's one thing that we are talking about. And of course, the external challenges which remain for the entire world, and not much can be done about it. But internal consumption is something that they are a bit more tentative about, that it might slow down. And that's why they have downgraded by 7%, rather 70 basis point. But overall, 6.3% growth is what is being envisaged for FY24. Just a quick look as to what happened overnight with the global markets as well, because yes, we were on a holiday, but the US markets were pretty much, on, and we saw a big reaction coming in as far as Dow is concerned, which was down a good 200 points. The Nasdaq was down 0.5% as well. Remember, there was the jobs opening data which has come, which talks about how the strong and the hot jobs market is cooling down a tad bit, and that's what led to that negative reaction coming in for the US markets as well. Oil continues to hover around that $85 to the barrel mark, so not big moves coming in, but do keep an eye out on gold as well, because in India it hit a record high yet again, surpassing the level of around 61,400. So that's something that we are watching out for. But in the meantime, let's listen into the opinion coming in from Ajay Srivastav, the CEO at Dimensions Corporate Financial Services as well. He's quite bullish on metals, capital goods, as well as hospitality is another space he's quite bullish on.
I think, we fundamentally believe that the metal stories which are there are long-term stories, high dividend paying stories. They're almost in monopoly status. And the fact that no matter what government control does, international prices have a linkage to this. So there's certainly at any correction, you need to keep buying metal in our view. And that's how, we've been doing that for the last so many years now, quite profitably, I hope so. But the fact remains that you need to invest in companies who are monopolists. That's one. Number two is high leverage is going to be a killer in this market. It's going to be bad for equities. Interest cost is going to go up. So if you look at a telecom company with 1 lakh crore of debt, they're going to pay a hell of a lot of interest on this cost. So I think interest. Number three is discretionary income product. Whether we like it or not, K-shape is a reality. Indians are high spenders on luxury items. So to that extent, if you look at the hotel industry, done well, will continue to do well in that market. So you need to be, cognizant of the fact that this part of the market is kind of inflation proof. Is done, in fact, the reverse. The more the inflation, the better they're doing at this point of time. So therefore, I think and last the least, if government wants to spend 10 lakh crore in capital goods, I think you have no choice but to enter that market. And good part, you got good MNC stocks in the system. Therefore, you can be safely sitting there, high dividends, good no leverage. If government wants to spend this kind of money, they will take it willingly. And you as an investor should partake. Best part, no dilution of equity of capital goods companies. So you're not fearing tomorrow morning there will be a big public issue, etc. In the automobile space, you're better off in the tractor segment, you're better off in the commercial vehicle segment than in the passenger vehicle segment. And we've seen how soon that so-called waiting list disappears in this market. So my bet, again linked to the capital goods sector, is the fact that you would rather go for sectors producing the bigger item, the capital good machinery items, the trucks, big trucks, etc., dumpers, because that will be in huge demand and there's a need to replace them every few years. You can't keep running like a car for 10 years. Replacement cycle of a dumper is 3 to 4 years. So therefore, you also see replacement demand coming much faster. Therefore, I would tend to believe that if you want auto space, the place to be is commercial vehicle, industrial vehicles, rather than being in the passenger vehicles.
Lots lined up today on the show, but time to take stock of technicals then. And we've got Naresh Mirani as well as Kunal Bothra joining in to walk us through their top ideas as well as levels on the index. Good morning, gentlemen. And Kunal, let's get in a take from you. After looking at Monday's price action, a fairly listless day of trade. It's a truncated week. We're not expecting any fireworks. So what exactly is the range that you expect the index to be confined to?
Good morning, Avan. Good morning, everyone. So I think on the indices, we've seen 3 days of very good rally for the Nifty as well as for the Bank Nifty. The broader market has opened up quite well in the last 3 days. So the indices have moved by I think 500 plus odd points from the from a Nifty perspective, and more than I think 1500 points odd for the Bank Nifty from 39,500 to 41,000 odd mark where we closed on Friday in terms of futures. So I think that's been a good rally for the indices. Now, the data point which is interesting, which happened on, in fact, rather on Monday, was that there was a very dramatic kind of a drop in the open interest for the Nifty as well as for Bank Nifty. Specifically for the Bank Nifty, there was almost a 30% drop to the current month futures, and we try and add this with the premium or the premium for the current month futures, and the premium for the Bank Nifty is just about 200 points. And the premium for the Nifty is around 70-75 points, which means give or take it's almost 0.5%. And given the kind of interest rates we are going through, ideally the premiums have to be 100 points as well as 300 points, which indicates that this is more of a long unwinding which is happening on the index futures at higher levels. So this could probably be a tricky kind of a data point. If the Bank Nifty falls back below that 40,000 odd mark, that's what I believe that a correction could probably start in. But as of now, the bias would remain bullish. But the supports have to be very strong over here. So 70,200 on the Nifty as well as 40,000 on the Bank Nifty. These are the two supports. Until the time we trade above these levels, the bias would remain bullish.
Naresh, hi, morning. After a day's break and a truncated one this week with Friday also trading off, we seem to be in good stead actually.
Yeah, so good momentum across the indices. It's not just the large caps doing well. The mid caps and the small caps have also recovered really well in the last ever since that March end selling got done. In the last couple of sessions, we've done well. And heading towards that 17,600 mark on the Nifty, that is where I would expect some bit of a pause. Similarly, at 41,000, 41,200 on the Bank Nifty would be a little bit of a pause going forward. So time to take some partial profits off on the Bank Nifty, continue to ride on to Nifty. There is some more upside left. But what we see right now is going forward, it would be more stock specific for at least a few sessions, instead of Nifty making major moves. And overall, 17,200, like Kunal said, continues to be a support going forward now. So time to be stock specific.
So let's get stock specific and discuss those top recommendations. Kunal, you go first. What are the top bets this morning?
So two buy calls which I would suggest, in fact one buy and one sell rather, which I would suggest at current levels. The buy is on large cap name. It's a buy on Bajaj Auto. We discussed the stock on Monday as well. Looking very interesting. The stock is confirming a breakout of a strong psychological 4,000 level. So it's come very close to that point. So it's suggest a buy with 4,100 as a target, stop loss at 39.45. And the second would be a sell on ICICI Pru, indicating that the stock is nearing a very short-term kind of a top as well as a resistance around this 440 odd mark. So keeping 447 as a stop loss would suggest a sell, targets of 428.
Okay, Naresh, what's on your stock list this morning?
So going with the first one, which is a buy on SBI, State Bank of India, there's a lot of catch up to be done with the rest of the banking recovery in the last few sessions. Out here, the stock has made a base at 500, 510, slowly making that pullback. The interim swing highs are around 560. That would be a target price for the stock. So a revised stop loss now at 515. Second is a buy on Indian hotels, which has gone through a multi-month consolidation, has not corrected much, which clearly tells you the longer-term uptrend is still intact, which started in 2021. And now it is setting up for a fresh breakout about 330 levels. So preempting that with a buy at current levels, that makes the risk reward much more attractive. A stop loss at 310 and a target price of 360.
Okay, there you have it. Those are the top recommendations that our chartists are looking at closely today. Let's move right on then. And it's not just crude, but natural gas has been in the spotlight. Do remember the government deferred the decision on changing the domestic prices as per the recommendations of the Kirit Parikh panel. The current rates are provisional, and soon the cabinet will be considering the panel's submission. We spoke as well with Kirit Parikh, who's heading the gas price panel, in order to understand the next course of action. Let's hear him out.
You know, as economists, we think about one thing, but politicians have to account for many other considerations. So I think what considerations is stalling them, I don't know, but maybe they will soon do it. I'm very hopeful because we had in our committee representatives of all stakeholders and they all have signed it. And I think we've taken care of all the concerns. So by and large, I expect the government should be clearing this, mostly what we have suggested in a short while.
Okay, let's try and understand the government's move coming in yesterday, wherein they have abolished the windfall tax on crude, on petrol, as well as ATF. Let me take it across to Prakash Priyadarshi, my colleague, and try and understand how this is going to impact companies and what exactly the government has done.
Yes, it's a big relief for domestic oil-producing companies as government has decided to withdraw windfall gain taxes on domestic crude oil production effective today. As per the notification issued by the Ministry of Finance, windfall gain taxes on domestic crude oil production has been reduced to nil from existing rupees 3,500 per ton. But it does not mean that the government has withdrawn windfall gain taxes on domestic crude oil production permanently. It is for the time being till next fortnight, because the decision that has been taken today is primarily based on the fluctuation in crude oil prices in last fortnight. But the government may take next revision as far as windfall gain taxes are concerned based on the current prices during next fortnight. However, when it comes to windfall gain taxes on petrol and ATF, as per new notification, it is still out of ambit of windfall gain taxes like last fortnight. But when it comes to windfall gain taxes on diesel export, as per the notification, the windfall gain taxes will remain there as far as diesel export are concerned, but government has decided to reduce it 50 paise per litre from 1 rupees per litre. But one important factor that should be taken into consideration is that there is a possibility that the windfall gain taxes may increase further due to fluctuation in crude prices in global market, primarily due to the fact that the decision that has been taken by the OPEC Plus nation to take further production cut. So it would be very interesting to see as to how government will move further from here on, whether the windfall gain taxes is going to be increased further based on the fluctuation in crude prices in the global market.
Okay, so that's the latest coming in from the government, but let's discuss it more with Sushil Choksey, the Director at Indus Equity Advisors as well. Sushil, hi, good morning. Thank you so much for making time and speaking with us. What do you make of the latest move coming in right from the levels of 23,000 thereabouts? Now the duty has been brought down to zero. What kind of a benefit do you see for the likes of Reliance, etc.?
Good morning and thanks for having me on the show. If you go by what the current notification and the rates which are notified, from the peak, government estimate was at the peak was collection between 30 to 40,000 crores, depending on the crude price when what was prevailing. And looking at the current price in the rupee terms, the tax is now below $1 billion on a total, so 7 to 10,000 crores. And if you look at the overall impact, domestic oil production, which is capped approximately at the current production level below 15%. So that's an incentive from a fortnight basis, but on an annualized basis, total collection would not still exceed 10,000 crores between oil, petrol, diesel, based on what tariffs are levied. And if you look at Reliance's peak outgo on the pricing on diesel, which was main product export, which Reliance was suffering, had gone past 8 to 9,000 crores at a EBITDA level for the segment. And that should be down to almost like 1,000 crore. And depending on the peak demand season for supply of diesel exports, so Europe was starving in winter to some extent because of Russian supplies. That stands to benefit, but it's a seasonality and a fortnight basis what government decides. Sentiment direction stays positive based on what has happened.
Sushil, many brokerages are saying that, the windfall tax removal can aid GRMs by $3 for Reliance in the near term. That's the word coming in from CLSA, and Morgan Stanley is saying that it's going to add to a 12% increase in the EPS. Would you concur with those calculations?
Yeah, depending on what price you are estimating on a total year basis. And virtually the ballpark would be, if you look at on a divisional basis, what oil and gas division and specifically the oil to chemical division contributes to Reliance, and it was to the tune of 10,000 crores. So that amounts to almost 10 rupees EPS per share if you take post-tax.
Right, and Sushil, would you just looking at the space as a whole on the back of this news coming in, which are some of the other beneficiaries and what's your view on individual stocks?
I don't have a particular view on the segment because government intervention and production levels are not that beneficial. Some of the oil and marketing companies were rallying a lot based on the crude prices which were prevailing in the previous fortnight. And based on OPEC decision, they've subdued a bit. But I suppose the marketing margins would stabilize in the current region. So valuation perspective, they seem to be fairly priced. But if you take a long-term prospect on a broad-based stock, I think Reliance stands to gain because the price is more or less attractive at 12-month bottom, except the previous week rally which we saw on the weekend.
Okay, Sushil, we'll let you go on that note. Thank you so much for joining us. But time now to go across to our research team. They're standing by to fill us in with the stocks which will be on radar. We have Harsh, Amakshi as well as Sharad joining in. Harsh, why don't you go first and talk to us about HDFC Bank? Solid growth when it comes to deposits. And really the pace of growth continues at HDFC Bank.
Well, yes, Anisha. In fact, both on the deposits as well as the advances side, HDFC Bank continues to be very solid. 17% growth through FY23 on the advances side as well. 6+% in a seasonally strong quarter. Fully appreciate that. But that's a very solid growth number of 6% when I'm looking at it sequentially as well, on a base that HDFC Bank has of 15 lakh plus crore. Let me take it to deposits, which has been the main focus area for the bank. 700 plus branches opened in Q3, which is what is aiding that deposit momentum largely. 9% up sequentially when I'm looking at the deposit growth number. The deposits grew by around 1.3 lakh crore. Or rather 1.5 lakh crore, sorry, I stand corrected, 1.5 lakh crore versus the full year deposit growth number of 3.25 lakh crore. So you're seeing extremely strong deposit growth number towards the fag end of this particular financial year. And that is pretty much common for all banks. Let me take it quickly to IndusInd, where growth has been quite stable. It's a good solid quarter from IndusInd. Advances grew 6% sequentially, 21% on a year-on-year basis. Deposits grew a solid 3% sequentially and 15% on a year-on-year basis. CASA stood at 40% versus the 42% it clocked at the end of Q3. Overall, a good set from IndusInd, steady set, and HDFC Bank, of course, a very solid set of numbers as well.
In fact, Harsh, stay with us. We've got lots of other banking updates as well to take stock of from you. But, there are several merger synergies for HDFC Bank. We chatted with the CFO, Srinivasan Vaidyanathan, as well. a few months back in his first ever TV interview. In fact, he also added that time that they will boost the mortgage and liability penetration as well. Here's him sharing with us the growth roadmap for HDFC Bank.
Call it about 60% of our branches are less than 10 years, right? Why is 10 such an important thing to think about, right? When a branch is opened, it takes, call it 2 years, 2.5 years to break even. Then it builds to a certain level in 5 years' time, right? Then between 5 and 10 years' time, it starts to bring in that multiplier effect. So it goes to 5 to 10 years, it goes to 3x of what it was in the first 5 years. So you have a 3 multiplier there. Once it gets past the 10 years, it gets to multiplier of 10. So the more the vintage of the branch, the better the penetration in that local base and the deposit base that it can bring in. So that's part of what, and the new branches that we are bringing in are filling that pipeline. As the 60% of the branches that are less than 10 years are progressing and moving in the scale up, we are trying to fill the front end so that this process continues for the next 5, 10, 20 years. At the end of the day, our deposit market share is slightly under 10%. Long runway to go to get much more market share.
All right, that's the lowdown on HDFC Bank, but it's NBFCs as well that will be in focus on account of their Q4 updates. In fact, M&M Finance as well has seen pretty strong growth in disbursements. The March figures were up 42% on an annualized basis. Let's put all those details into perspective. My colleague Vamakshi joins in from the research team to share with us those details. Vamakshi?
Well, absolutely. M&M Finance coming up with a strong operational update, ending the year on a very strong note. As far as the Q4 disbursements are concerned, they stood at 13,750 crores, which is an uptick of nearly 50% on a year-on-year basis. FY23 disbursements ended strongly at 4,95,000 crores, up nearly 80% on a year-on-year basis. Now, strong disbursements actually resulted in the gross business asset growth of nearly 7% sequentially. Asset quality, however, is one factor that is driving, that is actually stealing the show for M&M Finance. Gross stage 3 ratio has declined by nearly 130 basis points sequentially and 300 basis points on a year-on-year basis. In fact, this has taken it possibly to an all-time low of 4.6%. Bajaj Finance is also on our radar on the back of an operational update that the company came up with. The core AUM grew to 2,47,350 crores. When we look at it on a year-on-year basis, that is a growth of nearly 29%, and on a sequential basis, it is up nearly 7% on a quarter-on-quarter basis. Now, keep in mind that the growth in Q4 was expected at 6%, so that is definitely a positive coming in for Bajaj Finance. When we look at the new loan book during the fourth quarter, that grew by almost 20% to 76 lakh, and this is in fact the highest ever new loans of nearly 296 lakh that the company booked in FY23. Liquidity position for the company also remains quite strong, and in fact the company recorded the highest ever increase in its customer franchise of nearly 11.5 lakh in FY23. Apart from that, HDFC also came out with its operational update. They highlighted that their assigned individual loans amounted to nearly 9,340 crore, which is an uptick of nearly 12% on a year-on-year basis, whereas the individual loans sold in the preceding 12 months amounted to 36,910 crores, up nearly 29% or rather 30% on a year-on-year basis.
See, we leave it at that. In the meantime, Citi has also come out with a brokerage note on ICICI Bank as well as United Spirits. While Citi has opened a 90-day upward catalyst watch on ICICI Bank, they've also gone ahead and opened a 90-day downside catalyst for United Spirits. Why is that? Sharad is here to tell us exactly the same. Sharad?
Well, yes, a positive catalyst outwards coming for ICICI Bank, and of course they have maintained a buy rating with a target price of 1100 per share. Now, looking at the stock movement over the last 6 months, it has been largely flat, but the expectation what it is coming is that the Q4 numbers are expected to come in better than the street estimates, and this will actually lead to higher upgrades going ahead. Apart from this, if you look at the numbers, they're expecting at least more than 20% growth when it comes to operating core profit, and because of that there would be better earnings visibility going ahead. Apart from this also, there are certain segments which would be important, especially with the demand expected to remain at sustained level, especially for the retail, SME and the commercial banking space. And overall across segments is expected to have a 5% growth sequential basis and on 19% growth on a year-on-year basis. So that is Citi for you over a 90-day upside catalyst potential for ICICI Bank. Now, apart from this, on the other side, if you look at it, Citi has given a 90-day downside catalyst watch when it comes to United Spirits. They have given a maintain neutral with a target price of 815 rupees per share. But there are some concerns which they are addressing. The first one is being that there would be a near-term growth challenges, especially for the Delhi market because of the route to market changes which have happened. And of course, the innovations which are happening, they're expected to come in slower than anticipated. And they're expecting that the pre-popular portfolio sales level will take higher times to come to their levels. Apart from this, the stock has actually underperformed the Nifty. If you see, over the last 3 months itself, it's down almost 10% because of this margin dilution surprise. And also do remember that there might be consensus earning cuts going ahead for the stock. So we are getting two different views from Citi.
Talking about a positive watch when it comes to ICICI Bank, a negative one when it comes to United Spirits, and incidentally, JP Morgan has also put HCL Tech on a 90-day negative catalyst watch ahead of the Q4 earnings because they are sensing some sort of weakness to come by from the earnings this time around, and that's why a negative catalyst watch coming in for HCL Tech from JP Morgan. But Goldman Sachs' Timothy Moore has released a note on Nifty as well, when he expects the index to reach the level of 20,000 in 1 year. What else is there in the note? Pankaj, tell us all of that.
So it's a very interesting note which is coming in from Timothy Moore, of course, talking about emerging markets and within that talking about India. And he very categorically says that time to buy India has probably come in on tips. 20,000 is the level what they are looking at. So we are at 17,400. So that provides a decent upside over the 1 year. But it's time to accumulate equities, which means every time they go down, one can go ahead and buy. That's essentially their base case call. They are saying that one has to buy quality at reasonable price. At a point of time, India was trading at 100% premium to the emerging market. Valuations are now back to normal, and they believe that the premium, particularly which was there, is not gone away, but it's significantly reduced by about 60 to 70%, and that makes India look much better. Now, what they believe will change or what they believe will lead to the upside is firstly, earnings growth in India would tend to continue. It will be led by the banking names, and that is something which they believe one should go ahead and lap up. So it will be driven by earnings numbers for FY23 and 24, and that is one of the base case call that they have. 17 to 15% earnings growth and return will be back-ended as soon as we start to get earnings and upgrades would start to come in. They are overweight on banking names, as I told you. Industrial and cements are the other two sectors that they like.
Okay, thanks very much. That's the latest note coming in from Goldman Sachs. Moving right on, what are the top fundamental stock ideas? Let's take a look as to what exactly Neeraj Diwan is betting on.
Yeah, the stock I want to recommend today is KRBL. So they are one of the largest rice millers and basmati rice exporters. So recently we've seen a good build-up in inventory. The company procured 47% more paddy this year, and even the price has gone up by 15%. So the company, which is expanding into regional rice also, has announced a capex of about 250 crores approximately to be spent over the next 2 years for increase in capacity of regional rice, which sells as a premium to the normal rice in the market. So the expansion in the margin will happen because of improvement in the price of the basmati that we've seen. Plus the growth will come because of increased inventory in basmati and the regional rice capacity which will come from this year and increase in the next couple of years. And plus the company has a Saudi business which was hit earlier because the dealer was not there. So they've not wanted a new dealer. So there's improvement in business from Saudi. Plus the company is even looking at appointing another dealer in Saudi. So there will be even continued improvement from the Saudi business. So all this together will translate into a top line growth of 20 to 23% over the next 2-3 years, plus improvement in margin that we're already seeing should continue over 22 to 24, about 470 basis points. So if I value this company at 11 times 1 year forward, I get a target of 415, which is the return of for 20% plus over the next 1 year. So I recommend this for investment for medium to short term.
Well, we all know how crude oil prices have spiked ever since sudden production cut by OPEC. So we thought of getting you a discussion with someone who's a global authority in matters of energy. Joining me today is Dr. Fredun Fisharaki, who is joining us from the beautiful location of Hawaii, Honolulu. Dr. Fisharaki, thank you so much for your time. I was just going through the report and my eyes almost popped out that you're making a case with the recent developments which have happened in the environment that crude could even head to $100. Talk to us about what's the hypothesis you're building.
Well, usually OPEC intervenes when they feel that there is something wrong. The demand is very weak, or inventories are building up, or different people may be overproducing. And none of those conditions are present. The demand is very strong. Inventories are neutral, sideways, they don't go up. And nobody is able to overproduce. So the move was a great surprise. And OPEC must have thought that they are preventing something which may be happening in the next few months. And they wanted to preempt it by cutting the production early enough. So it took us all by surprise. And $100 easily achievable, and even more than that is possible.
Raki, there is also an argument on the table which says that OPEC of course, they may have been a little more ahead of time, but it is also a sign, this move production cut is actually a sign that demand is weakening ahead going forward in the next couple of months. And so they have taken a preemptive step to adjust that. What are your thoughts on demand trends?
Well, we don't see it. Frankly, we see the demand quite strong. We see the demand growth this year, 2.5 million barrels per day, of which maybe 1.5 million barrels per day is COVID recovery, and 1 million barrels per day based on the strength of the market. So very bullish on the demand side. So if OPEC is seeing something, we don't see it at this stage. It is possible that they've had difficulty finding customers in Asia, particularly in China and India, as they're buying so much Russian crude. So they say, okay, we see some weakness in, maybe not in demand, but in procurement, and taking some action. I'm sure they have good reasons, but as of today, we can't see why they did it.
Dr. Fisharaki, there is a saying in global energy markets, an old saying that oil business is 1% business and 99% politics. How are you witnessing geopolitical, tension between some of the large geographies which consume a lot and produce a lot as well? For example, US has now become a net producer, net exporter of oil. How are those equations also playing a part in energy markets right now and these steps which are being taken?
Actually, I don't agree with the theory of 99% politics, 1% oil. I think that is 70, 80% of it is fundamentals, supply demand, and maybe 20% politics. So maybe that was true 20 years ago, but not today. US now is the largest producer of oil. And if you add crude and products together and condensate, the US is exporting more than Saudi Arabia. But US is also a huge consumer. And consumer means that most of the oil that they produce, they end up using it themselves. So they are different from Saudis, where they have extra oil that they export and they can control it. In the US, there are small producers, private producers. The government almost has no role in this matter at all. The government is just a bystander. So private companies run the show. But the geopolitics do impact things. At the moment, we see the Saudis and the Iranians reaching a diplomatic solution. We don't see any big geopolitical issues in front of us. In case of Russia, the price cap for Russia has failed. Russian oil still is flowing pretty much as before. And the Russians are basically replacing all of Europe with China and India and Turkey. And oil is still flowing at discounted prices, of course, but the flow of oil cannot be stopped by politics.
Dr. Fishaki, how do you see the role of China reopening and economy coming back? Some say that it has actually been slightly on the softer side, the China reopen, versus what they had estimated earlier. So demand did not come back in the in a big fashion in China, and that is why OPEC actually took these steps to adjust the production. What are your thoughts on China demand?
Well, you know, the difference between China and India is that in China, only one person decides everything. In India, 10,000 people have to decide everything. That's why things don't get done so easily. In China, based on what we understand today, we are still pretty bullish about the recovery. It may not be as great as everybody had hoped for, but it's still 600,000 to 800,000 barrels per day of demand growth. So most of the demand growth, both in COVID recovery and economic growth, is still we expect in China. So we remain quite bullish. Now, maybe the Saudis see some weakness at the end of the road in there and decided to preempt. But, for the first time last month, China imported more crude from Russia than India did, 1.4 million barrels per day. And Chinese also are exporting refined products based on the cheap Russian crude, substantial amount, more than 1 million barrels per day. So it is still not 100% clear that they will recover as quickly as we all hope for, but the signs are very positive.
Fishaki, in traditional economics, the formula which applies is that for market share gains or gaining market share, a lot of companies go ahead and start cutting prices to compete in the marketplace. Over here, the two biggest buyers, China and India, biggest buyers of crude, are now tilting more towards one big supplier which wants to digress away from Europe to other buyers towards us, which is Russia. How is the market share dynamic playing out in the global energy market, from the big producers' point of view?
Well, the oil market is like a big swimming pool. If you take one bucket of water from one side and throw it to the other side, it's still the same swimming pool. So before, the Russians were supplying a great deal of oil to Europe, and the Saudis, Iraqis, and the Kuwaitis were supplying, and the US was supplying China. Now, China and India, they are buying more from Russia and buying less Saudi crude, less Middle East crude, less US crude, less Kuwaiti crude, less Iraqi crude. So the market balancing itself still. If there is a willing buyer and a willing seller, oil moves. So there is big swimming pool. In the LNG market, there is not one big swimming pool. There are many small pools which are not connected. But the oil market is connected. And so far, everybody who wants the oil can get it. The people who make a lot of money are the shipping people. To bring a barrel of oil from Europe to India may cost $15 a barrel of transportation because it's in the wrong place. So a lot of extra money is paid by the people who want to do the shipping outside of the normal, natural home markets. But there are now 600 ships in the so-called dark fleet, which is not registered by anybody. They're small, old ships. And people are there and they are moving the oil without having to worry about the European insurance, European price cap, and all the rules of G7. So it is moving. Surprising to everybody else, it is moving much better than everybody expected.
Dr. Fishaki, how are the inventories standing right now world over by great producers, big producers, and what is the role of inventories actually playing out?
Well, inventory, you can define it as the running inventory. Running inventory is flat, but in terms of the surplus capacity was 2 million barrels per day, now it's 3 million barrels per day. So it gives a little bit of more safety and security in case there is a turbulence in the market, because those with the extra capacity can come in and fill the hole. the market feels very worried if the excess capacity is less than 2 million barrels per day. Today, with this latest move from April 4, the excess capacity is over 3 million barrels per day. So it makes the supply security much more acceptable.
Dr. Fishraki, one last question. Coming back to the main hypothesis which you had, that possibility of $100, how much probability would you assign to that, and what kind of time frame, given the way economic data is coming, demand trends, running inventory, all of that? Are we talking about a 6 months kind of a window where $100 prices edging towards that is possible, and how much probability would you assign to that?
I think probability is 90% or more. So when you do the balances, it's obvious that second half of this year would be very hard to contain. So when would it go reach there? It would be third and fourth quarter, and definitely by early 2024, and may go higher than $100 too. So $100, $95 to $105 is our assumption.
That's a very big takeaway coming in, Dr. Fishraki. Thank you so much for joining us on the show today. Dr. Fishraki is a global authority on energy. Everybody listens to, actually is making a case by third or fourth quarter of this year or early next year, we should be ready for $95 to $100 base, but the window is also open for higher prices from there. China recovery has been strong, and the dynamics are actually favoring and that the higher prices, and that is the reason OPEC came and actually surprised the world with the production cut. It is very relevant for emerging markets like India, who are big importers of crude. Yes, we have started incrementally importing more at a discounted price from Russia, but still large part of our crude import basket, it's important for our viewers and market watchers to know, still is Saudi and rest of the world crude. So our basket does get impacted. So you need to keep an eye on that fundamental, which Dr. Fishraki was pointing out very closely. With that, guys, it's back to you in the studios.
Yes, indeed. Those are some of the top takeaways. Thanks very much, Ajay. Also, Dr. Fishraki saying that OPEC may have had a good reason to cut production, but as of now, he doesn't see it. All right, let's get right back then to our chartists and find out what their views are on individual stocks as well as movers in trade. And Kunal, let's get in your take then on those auto stocks. They clearly lit up the screen on Monday's trading day. If you had to cherry pick some smart movers that could continue the price action, which would they be?
So from the auto pack, I'll still stick to Bajaj Auto as a trending bit or a stock which is on the verge of a breakout. So we discussed this on Monday as well, that how the stock has formed a triangular pattern on the longer term time frame charts, and it's on the verge of a breakout at the 4,000 odd mark. So possibly the stock crosses about this 4,000 level, say in the next couple of days. We can expect a steady up move for Bajaj Auto and possibly a start of a multi-month uptrend and an end of a consolidation which has been going on for the last 1.5 odd years. Now the other names, the likes of M&M, for example, a stock which had done fabulously well in the second half of 2022, rising up from almost 700 to 1400 plus levels. That stock has gone to a correction, 2 straight months of correction for M&M, and the stock has corrected from 1400 to 1100 or slightly below those levels. So this indicates that the mojo for M&M is not as strong as what was maybe in the second half of 2022, and possibly the stock may consolidate as well as correct over the near term. So I believe that in this kind of a flux kind of a situation where the data points from the auto packs are changing quite consistently, I think it makes sense to stick with the stocks which are riding on high momentum. So I'll stick to Bajaj Auto as of now.
Auto in high momentum, while M&M might be in the slow lane for now. A bit of consolidation is what Kunal is expecting. But let's welcome on board Hemang Jani as well, the equity strategist at Motilal Oswal Group. Hemang, hi, good morning. Thank you so much for making time and speaking with ET now. Well, a slew of Q4 updates have come in from the banking and the NBFC sector. Let's begin with HDFC Bank itself. Really, the pace of growth continuing at a very strong momentum for HDFC Bank. Your take?
Yeah, good morning. I think the overall business updates, majority of the banks NBFC have been pretty good. HDFC Bank, on a YOY and a quarter basis, we're seeing very strong growth, particularly the credit growth is looking quite, and I think that given the back in the last about 2-3 months.
I think we've got you on a bit of a patchy line. We'll come right back to you and discuss the fundamentals. But in the meantime, why don't we get in a take on some of those banks that have come out with their operational updates on the charts and what your outlook is. Nuresh, let's get in a view from you as to how you're looking at some of these, NBFCs, banks, HDFC Bank. What's the chart of IndusInd Bank, Bandhan and Bajaj Finance, etc. indicating?
Start off with HDFC Bank. The stock last saw a big move from 1530, 1550, went up to 1700, retested that 1530 band and has started making a bounce back over the last couple of weeks. Now, overall, the target for the upside continues to remain at 1650 to 1700. It's only when it starts crossing 1700 the trend changes in a big way, in a meaningful way, because that's been a problem area for the last 2 years. But the trend is shaping up for even eventual breakout above that mark. So HDFC Bank looks interesting. Bajaj Finance, on the other hand, is a stock where there should be a bounce back trade, but it is no more going to be a leader. That is what the indication is. The stock last broke out about 5500 in 2021. Went up to 8,000, has made 4 or 5 attempts around that 7,500, 8,000 mark, and has corrected good 20% every 20-25% from that a couple of times. So clear underperformance with the indices. So this indicates we are getting into a zone wherein it will be sideways, wherein a near-term bounce back towards 6,000, but 7,500, 8,000 could be a very long journey. Going through a correction after a really long period of outperformance. So this could last many months or even a year or so, where the stock is not in the reckoning for a lot of momentum trades. Bandhan Bank is one which has been the worst performing one. The stock corrected all the way from 350, 400 in 2021 down to sub 200 levels. The recent breakdown point was 215. So 215 could be a resistance in the short term. So only when it starts sustaining about 215.20, the trend changes.
Hemang, let's get right back to you. Continue your chain of thought. You were talking about HDFC Bank.
So, HDFC Bank, the numbers were pretty strong on a higher base, both YOY and quarter on quarter. We've seen a good, strong growth in the credit, growth, which is quite, interesting. Also, coupled with that, when we look at the names like Mahindra Financials, Poonawalla FinCorp, Federal Bank in the banks, I think these are the names where the overall business update is extremely strong. So we think that now that we are entering into earnings season with this business update and the previews which are out, we think that particularly the banking sector should do well, both PSU and private banks.
PSU as well as private banks are likely to do well when it comes to the earnings season. But since we're talking about earnings season, Hemang, it doesn't look it's going to be a pretty one for the IT sector as a whole. A lot of expectations suggest it's going to be muted when it comes to top line, and all eyes will be on the commentary and the guidance for FY24. Ahead of that, how should one position themselves when it comes to the IT sector? Should they wait for the weakness to be out, or is it a good buying opportunity after the correction?
So overall, we think that IT sector also should do relatively better, compared to a Nifty, primarily because we've seen some stabilization in the financial vertical, which is very high for many of the corporates, and that should give some stability. Also, the fact that the entire sector underperformed big time last year. So, the valuation comfort is pretty much visible, and we think that the large cap companies, maybe Infosys, TCS, HCL Tech, that is where we do not expect any, negative surprises. So I think both valuation comfort is there. The numbers should be by and large okay. Yes, because of the consolidation globally, let's say between Credit Suisse and the UBS, there might be, company specific issues here and there, but by and large, we do not see any major challenge for the IT names.
Okay, so don't see a big challenge for the IT sector as a whole, but today a whole host of other stocks will also be in focus from the NBFC space. You talked about Poonawalla FinCorp, but, Hemang, wanted your take regarding Bajaj Finance and HDFC as well in terms of the growth that we have seen. It continues to be strong, but valuation-wise, you see comfort on these names?
So Bajaj Finance, the numbers were pretty much okay, but the larger concern over there is that versus the valuation, how the numbers are stacking up, and there is some, degree of gap there. So we're not very positive on Bajaj Finance per se. HDFC, I think, because of the way the interest rates have moved up on the housing finance part, we have to really wait and see the impact on the actual disbursement. But overall, because now it's a merged entity and HDFC Bank is doing well, maybe it may not have any major negative repercussions. So overall, we think that we have to take a stock-specific approach when it comes to NBFCs because the interest rates are high, and that would have some bearing on the NIMs for some of the companies.
And what about consumption as a space? Because we have only got numbers from, Marico at the moment, and it doesn't look very strong because it's only a single-digit growth that they're talking about on the top line. And the commentary on inflation is positive, but doesn't look like we're out of the woods.
Yeah, so we have to wait for the updates. More importantly, the quarterly, earnings and the outlook that the managements are giving out, because there has been a concern on the overall growth when it comes to rural side. But now that we are into earnings season, we will have a slightly more clarity. I think the sector looks a little, high in terms of valuations. But if the growth is in line with expectations, people really would want to look at it. So from that perspective, I think we should have positive bias on names like Godrej Consumer, HUL, Dabur. I think these are the names where we have a positive bias, but we would wait for the actual commentary.
Hemang, where is right now in the market do you see value? Because a lot of global brokerages are now saying that India valuations have halved from their peak. They do find merit in terms of a valuation comfort, and they do believe that India is now a buy on dips market. Wanted to understand what's the house call in terms of stocks that one can buy right now?
So Aisha, the broader valuation comfort is there in banking and financial services, particularly I think PSU banks is where there's a higher degree of valuation comfort, and the quarterly preview suggests that the growth is going to be much higher than even the private banks. So that's number one. Number two, private banks again should do pretty well quarter on quarter. Also, should report good growth. The valuation comfort is pretty much there. I think IT is something where there are mixed views, but our sense is that at these valuations, given that these companies are going to deliver relatively good growth, particularly the large cap names, Infosys, HCL Tech, TCS, we definitely have a positive view there. And apart from that, some of the beaten down names, maybe a Reliance Industries where the stock has actually underperformed big time. I think both in terms of their retail, the telecom business, and the O2C where the refining margin part we can see some good stability. So I think these are some of the names where we have a higher conviction and evaluation comfort both.
Kunal, let's stack up the charts for Bajaj Finance, which has been beaten down off late. And the other one, of course, HDFC Bank, which within the last 52 weeks is now sitting at pretty much around the highs. So yes, Bajaj Finance standalone. And if you could just stack up an ICICI Bank and HDFC Bank for us, because that's where the comparisons are being made, whether at this juncture one should stick by with an HDFC Bank or choose an ICICI Bank over it, if one had to really make that choice.
So I think it's an interesting question, Aisha. So, Bajaj Finance had done exceptionally well at a point, I think, in the second half of 2022, or rather in the, in the months ending August, September 2022. That was a point when the stock had rallied up significantly high. I think 7,500 plus levels also were achieved for Bajaj Finance. But somehow in the last 4 or 5 months, consistently, the stock has gone through a very sharp correction. It was one of the very few large cap names which had actually broken below the long-term averages, much advanced, compared to many of the other peers in the group, as well as from the banking pack, if we try and do that comparison. Now, yes, the question is that, whether HDFC Bank and ICICI Bank hold a lot of merit. Yes, I would believe HDFC Bank and ICICI Bank could be top candidates of a strong breakout from current levels. Look at it this way: the last 1.5 or 2 years, Bajaj Finance had its period of uptrend as well as a phase of correction. But HDFC Bank, ICICI Bank, largely these stocks have gone through a time-wise correction, specifically more on HDFC Bank. The stock has been at the 1600 levels in 2021, in 2022, as well as currently in 2023. So that itself indicates that the stock has gone through that time-wise correction.
link. Kunal, do go ahead if the audio is clear.
Yeah.
Right.
So I think HDFC Bank, as I was indicating, Avan, that the stock is looking very attractive on the charts compared to even the likes of the frontline other banking names. Axis Bank, for example, the stock is correcting. IndusInd Bank, the stock is also going through a correction. So as of now, I would believe HDFC Bank looks to be far more stronger bet. And if there has to be a relative trade over here, then I would prefer HDFC Bank as compared to even the likes of Bajaj Finance, Finserv put together.
Okay, that's the view coming in, and just stick by. There's the pre-open rates as well flashing on your screens, and a bit of a tempered start at around 17,390 on the frontline index. Hemang, what's the outlook when it comes to Bharat Dynamics? Because the company recorded a turnover that is at about 2,400 odd crore rupees, quite a significant decline. A number of factors being attributed, and it is expected to be recovered though in the current financial year. A cause of worry, or you believe that this will be recovered and it shouldn't be too much of a concern?
So we think that defense names, there is a lot of buzz and people are a little excited about the whole story and the way the government has gone about giving orders to some of these names. It definitely has a feel good. What one must bear in mind, is that on a quarter-on-quarter basis, you will not have that sort of linear kind of a growth that typically the market really would want to have. So because of the nature of the business and the way the government goes about giving orders, even in case of Bharat Electronics, last quarter we had seen that there was a bit of a slowdown. So one has to really look at a slightly bigger picture, and from that perspective, we think that HAL, Bharat Electronics, Bharat Dynamics, one can have some allocation with a 2 to 3 year kind of perspective, and if you see any dip in between because of some negative surprise, I think we should use that as a buying opportunity.
Okay, Hemang, stay with us. Lots more to talk about. Going to quickly detour and get in some more trading ideas this time around from the mid-cap space. Naresh, what's on your mid-cap radar?
So looking at a buy on Laurus Labs, the stock has corrected one way from almost 700 levels back in 2021. And then the recent tops in August of last year was around 600. The stock has collapsed 50%. And now yesterday was the first indication of a reversal candle. The last 3 days has seen a relatively higher volume. So a risk reward trade here, a strict stop loss at 297 and a bounce back target price of 330.
Okay, what about you, Kunal? What are the stocks that you're recommending?
So it's a buy on Century Textile. I think interesting chart for the stock. It's closed almost at its swing highs. On Monday's trading session, 662 approximately is the breakout for Century Textile, and I would believe that the stock would probably, riding on high momentum, would provide the breakout pretty soon. So buy with a target of 688, stop loss at 640 for Century Textile.
All right. Hemang, just get in a quick word from you as to what exactly your outlook is when it comes to the defensives. Where within pharmaceuticals or FMCG would you be finding comfort? You did talk about your outlook on the consumption space, but within pharma, where would you cherry pick?
I think having seen a big underperformance in terms of valuations, that sector should do better this year. And what we feel is that because each company has its own dynamics in terms of growth, valuation, comfort, etc., we would be more comfortable with names like Sun Pharma and Dr. Reddy's, because that is where we've seen some stability and major negative surprises in terms of US FDA alerts, etc. So definitely these are the two names which are high conviction ideas within the pharma space for us.
Hemang, always great to chat with you and have you on the show. We let you go on that note. Let's also tell you what else is happening outside the world of equities. And Amazon has laid off about 100 employees in its video game division as part of its broader cutbacks. The move impacts workers at Prime Gaming, Game Growth, and the company's San Diego studio. In fact, the UK watchdog has also slapped a nearly $16 million fine on TikTok for breaching country's data protection laws, including the misuse of children's information. In fact, authorities have estimated that the app has allowed as many as 1.4 million UK children under the age of 13 to use its platform in 2020, despite the prerequisite minimum age being 13 to create an account. Also, Johnson & Johnson unit has filed for a second bankruptcy to pursue a whopping $8.9 billion in the talcum settlement. Do remember, the company faces thousands of lawsuits alleging that its iconic baby powder or talcum powder and other projects caused cancer.
Okay, shifting focus to what's happening in Finland, because that's become the latest and the 31st member of the North Atlantic Treaty Organization, or as we know, NATO, marking a major shift in the security landscape of northeastern Europe. The move comes as member states sharing borders with Russia have nearly doubled in the recent time. Also talking about what's happening with the central bank activity then, Pakistan has gone ahead and raised their benchmark interest rates to a record 21% amid soaring inflation. The State Bank of Pakistan's Monetary Policy Committee raised the target rate by 100 basis points from 20% earlier to 21% now. The rates are now at their peak since central bank figures dating back to 1956.
All right, let's get a move on then, and lots more to talk about with respect to the khabar on D Street, as well as what the outlook is when it comes to individual counters. My colleagues Ashesha as well as Lisa join in for just that. And Ashesha, I'm going to start off with you because Hindalco has held its investor day. The management has, maintained their medium-term guidance, and profitability is expected to bounce back. What exactly is the khabar there?
Well, yes, Hindalco conducted their investor day meet yesterday, and they have retained their medium-term guidance. As far as profitability is concerned, management expects to reach its steady-state profitability of $525 per ton by the fourth quarter of FY24, which stood at $376 per ton in the third quarter. They say near-term weakness in profitability is driven by customer destocking and high energy costs, which has been impacting numbers for the last many quarters. Profitability, they believe, will bounce back as volumes recover and costs are passed through to their customers. As far as capex plans of the company are concerned, they said that capex over FY24-28 has been paced out. It now stands at $4.4 billion worth projects which are already under construction versus management's earlier guidance of $8 billion. In fact, CLSA has come out on with a note on the back of the takeaways that have come in, where they say that feedback from the investor meet was rather mixed. Concrete timeline for Novelis profitability is expected to bounce back, and that is a key positive. However, quantitative details on factors driving weakness and items to monitor for recovery was rather missing in the investor meet, and they believe this is a negative outcome on account of this meet that has come in. At 5.3 times FY25 EV to EBITDA, CLSA believes concerns are rather priced in, and hence for now they're maintaining their buy rating on the stock with the target price of 550 rupees per share.
Right, Ashisha, we'll leave it at that. That's the call coming in on Hindalco. Meantime, the international pizza restaurant operator Papa John's has announced it will open as many as 650 stores in India by 2033. In fact, the first outlet is expected to come by next year, that's 2024 in Bangalore. And Lisa is here with more details on what exactly do they have up their sleeve, how many, how many stores are they looking at opening, and what exactly is the timeline? Lisa?
Well, yes, Papa John's International, which is a US-based company and one of the world's largest pizza delivery company, they have announced a large presence in India. Well, they have announced that they would be opening around 650 restaurants in the next 10 years, that is by 2033. And the first restaurant will be opened by next year in Bangalore, and then that will be followed by more openings in South India and then across the country. Well, to get the facts straight, this is not the first time that Papa John's has entered India. It had entered India earlier, and it is a re-entry of sorts for Papa John's, as it had exited in 2017 over poor store economics, and they had shut their Indian operations. Now, the challenges that remains for Papa John's to be successful in the Indian market will be the menu localization and also its ability to create a positive image in the consumer's mind. And they will be entering India through its international franchisee partner, that is PJP Investments. Well, talking about the industry dynamics, this could result in increased competition in the already crowded pizza category space, and this could also reflect in increased cost to attract consumer footfalls as well as higher investments in store additions, and that could impact companies like Jubilant Foodworks.
Okay, Lisa, thank you so much for joining us with that update. The pre-open rates have settled. They are a tad bit lower than what the SGX Nifty was suggesting, is just around at 17,420 thereabouts, while the SGX Nifty was telling us that maybe we'll see the levels of 17,500. But what happens once we open around that level? Let's get the index calls also going. Kunal and Naresh believe it's best to hold as of now after that almost 400-point rally that we have seen in the last 3 days. Maybe there's going to be a bit of sideways move. That's the word coming in from Kunal and Naresh, while Santosh believes it's good to buy. So consensus hold coming in for Nifty. Similarly, for Bank Nifty, Kunal believes it's good to hold. Naresh believes, in fact, it might be good to book profits today after we see moves coming in on the banking names after the Q4 updates. And Santosh believes there might be more upside. So maybe at open, you can buy further. So a bit of mixed view coming in as far as Bank Nifty is concerned. Not really a consensus call, but one says book profits, the other says hold, and then lastly, you have a buy recommendation as well.
All right, let's find out what exactly our charters are tracking by way of their top mid-cap recommendations this Wednesday morning. And we've got those bets as well down the line. But in the meantime, just let's get in a view then, Kunal, as to what your outlook is on Reliance Industries.
Yeah, I think this could be a good double positive data point for Reliance Industries. Last week as well, there was a lot of news flow for the stock price. It moved up from 2,200 to 2,300 plus levels quite comfortably. So I think this move should now probably elevate the stock a bit more further. We could now expect a possible upside towards even 2,400 for the stock price. So in the last 2 or 3, 1.5 to 2 weeks approximately, the stock has had 2 big days of strong price action for itself, and both of those days for Reliance Industries were accompanied by a very strong set of volumes. Now that's a decisive change of pattern for the stock price. Now if we see the stock scaling past about the 2,400 levels, and assumingly even if the stock consolidates at the 2,400 mark, say maybe spends a couple of days or a week approximately at those higher levels, we could still expect that the stock would try and get into a trending phase from here on. So the last 2 strong candle moves for the stock price indicates that the trend has changed for the positive for Reliance Industries. We would now expect 2,200 to be a big support for the stock price, and keeping that support as a stop loss. I think from a positional play, traders could still look at a buy on Reliance Industries or hold on to their positions if they've bought at low levels.
And holding up in the green as we speak right now, 23.48. It's a buy call coming in from Kunal as well on Reliance Industries. In fact, let's just take a look at what some of the other stocks would be doing, not just Reliance, but ONGC as well. Given that the windfall tax on crude has now been reduced to nil, then of course you are going to look out for, after that extremely robust fourth quarter update coming in from HDFC Bank, I want to see what that stock as well is up to in trade right now. That stock will just come up for you on your screens, holding up higher by about 0.5% or so. Bajaj Finance as well, good commentary coming in there. The AUM growth coming in at almost 7.25% on a sequential basis, best in about 4 quarters, and the new loans as well have notched up about 20.6% on a year-on-year basis. That's Bajaj Finance and Trade for you, one of the biggest movers this morning, 2% higher on that stock as we speak right now. And then, of course, update coming in from HDFC, update coming in from Marico as well. Britannia, and a sizable dividend here. Not just that the stock has been one of the best performers of the previous fiscal, but the board has also approved a dividend of 72 rupees per share. That should make shareholders happy. Stock, though, a little bit tempered in trade as we speak right now. And just one more data point, the North America Class 8 truck orders are now down 10.25% on a year-on-year basis, and a 16.7% decline that you're seeing on a month-on-month basis. So a typical correlation would be to Bharat Forge, and maybe that stock would be in the red as we speak right now. But just getting set for the market open this morning. Lots on our plate, even though it's a truncated one, with Friday being yet another trading off. There you go. Paytm as well. The average monthly transaction users stands at about 90 million for the fourth quarter, which is an uptick of 27% that they are seeing on a year-on-year basis. But for the market, looking at the SGX Nifty, it seems like it's going to be one of those quiet sessions, a quiet start, at least going by the index performance. Of course, individual stocks could, do whatever they do. There's also AU Small Finance Bank, wherein the loan growth rate has actually declined. So maybe that could be a sour one this morning.